let's consider accounting for income taxes and a relatively simple example. So the basic idea that causes us to account for income taxes is that there are differences between generally accepted accounting principles and IRS tax rules. A big question we have to consider is, will there ever come a point where the total amount of revenue or total amount of expenses between generally accepted accounting principles and IRS are the same? Let me give you an example. If in 2014 GAAP income is higher, but 2015 tax income is higher by the same amount, then we would say that they'll be the same one day. And it's just a timing difference. Perhaps expenses were lower in 2014, but then higher in 2015. So if they will ever be the same, or another way to put this is, if differences will correct themselves, then we say they're temporary differences. And you're going to see we're going to have to do some accounting for them. On the other hand, it's very possible that there will never be reconciliation between GAAP income and IRS or taxable income. And if certain differences will never correct, we call them permanent differences. Now, as you'll be able to tell by reading the chapter, there are a great many examples of temporary differences, and there are a great many examples of permanent differences. Even the book can't give you a complete listing of these. So certainly the brief overview I'm giving you doesn't consider all of them. Just a small sample. So one example of a temporary difference is those unrealized gains or unrealized losses that we talked about back in chapter 12. Particularly think of the trading gains and losses for investments to be traded. Here, if you remember, we had to record the gain or the loss right away for trading purposes. It was a little bit different with available for sale or held to maturity investments, but just think about the trading ones for a minute. On the other hand, the general tax rule, it's not always true, but the general tax rule is that we don't recognize income until we receive it, and we don't recognize expense until we pay it. So here, even though we might have an unrealized gain, we won't necessarily have a tax consequence until we recognize the gain later on. So this will be a temporary difference. Depreciation is another common one. We talked about depreciation in the first semester. But one thing that came up then, and it came up in your principles class, is that for GAAP purposes, a lot of different methods are possible, but most of the time we use straight line depreciation. On the other hand, for tax purposes, we're encouraged for many types of assets, most notably vehicles and equipment, to use accelerated method. And that's not necessarily double declining balance. It's double declining balance with some special tax rules thrown in. What you need to realize is many companies would like to have big tax deductions. So they would like their expense to be big for tax purposes, while the expense is not big for GAAP income purposes. Because remember what we do with GAAP income. If it's a public company we're talking about, if it's a company whose stock is traded on the stock exchange, then managers and owners want the income to be big because they might want to sell stock and they want potential investors to see good income. Similarly, if it's a privately held company, if just a family owns it, then the biggest purpose of GAAP income might be to try to get a bank loan. Again, you want net income to be high. But when you're reporting to IRS and getting ready to get the checkbook out to pay your tax bill, you want the income to be low, which means you want expense to be high. So things like depreciation, usually the tax rule allows a bigger income in the current year and smaller income in the future years. Or I said that wrong. A bigger expense, therefore a smaller income in the first year, and a smaller expense, bigger income in future years. There's an old rule that you learn when you take the tax classes. You hear it in my class. You certainly see it when you go to work. And it is, when you're thinking about tax, any tax bill that can be paid later should be paid later. And so not only are we talking there about, if you can wait until April 15th to pay, we're also saying if this year you can show high expenses and it's legal, and so your tax bill's low, and next year you won't be able to show those expenses because you showed them this year and the tax bill's high, take your chances. Pay the low amount this year and see what happens next year. Anyway, unrealized gains and depreciation would be a few simple examples for temporary gains or losses. On the other hand, certain items are permanent differences. They'll never be corrected. And here are a few examples of these. Again, this is not all of them. Meals. The IRS rules for some time, both for businesses and individuals, are that meals can be deducted at 50%. It used to be that the IRS dickered with taxpayers about whether there was business discussed at the meal or not. Now they simply say, if you're trying to deduct a business meal, you can deduct half and you can't deduct the other half. And we don't care what it was about. So what happens here then is half of the bill is the same between generally accepted accounting principles, it's an expense, and IRS. But the other half, the IRS is never going to allow as an expense. So this will never correct. As another example, life insurance proceeds are generally not taxable. So if we wind up having life insurance on a key person in the company and that person dies, the income we receive in proceeds would be GAAP income. We would show it as income for the year, usually as another income item. However, it will never be taxable income. So that's a permanent difference. Let's consider this simple example. We've got 4 items, and let's look at it as a simple problem. The 4 things this very simple company has that could be deferred tax asset or deferred tax liability will be booked to tax differences, IRS to GAAP differences. Or there was an unrealized gain on securities, trading perhaps, for $5,000. There was depreciation on a work truck. The straight line depreciation on the work truck was $5,000, but the tax accelerated depreciation was $10,000. That means the company got a $10,000 deduction this year for the work truck, but on the accounting records it only said $5,000 was the expense for the truck. Company meals was $1,000. And this year, unfortunately, the business lost its founder, and they had life insurance proceeds on the founder for $100,000. Okay, hopefully you see the problem here. We have 4 items: unrealized gain $5,000, difference between tax depreciation and straight line depreciation of $5,000, company meals of $1,000, and life insurance proceeds of $100,000. How do we account for these for income tax purposes? Well, the unrealized gain will cause us a future tax of $5,000 later. We've shown that on the accounting records this year, on the GAAP records this year, and we'll be taxed on it later. For depreciation, the IRS depreciation was $10,000, the GAAP depreciation was $5,000, therefore there's a $5,000 difference. There's $5,000 of income that we could offset tax against for IRS purposes, but not for book purposes. So later, there'll be a tax on $5,000 more dollars. Those are the 2 temporary differences. Now remember the other 2 items, the meals and the life insurance proceeds, are permanent items. So we don't have to look at those as deferred tax assets or deferred tax liabilities. So what we have here is $10,000 of future taxable income. Well, one thing you have to do for GAAP basis accounting for income tax is you have to estimate what your likely blended tax rate will be. So if you've had the tax class already, you may realize that tax rates are complicated. You probably have not had a corporate tax class, but you might have had an individual tax class. Well, the corporate rates are different and they're based on different things. However, the basic idea that you see in individual income tax, that at low levels of low levels of taxable income, the company pays low tax, and at high levels of taxable income, the company pays high tax. That's a pretty standard philosophy, and it carries through to corporate tax. So a 25% blended rate is pretty realistic. I think if you looked at the tax bill that most successful companies were paying. Now, many companies don't pay any tax at all, and that's because really they're not in very good shape. But if you look at successful companies and companies that are following the rules and the law, 25% likely rate is fairly common. So if we determine that's what our company's tax rate is likely to be, at low levels the taxable income's lower, at high levels the taxable income's higher, it comes to a blended rate of 25%. The idea that we would have $10,000 of future taxable income times 25%, and it gives us a $2,500 likely income tax later on, is realistic. So we've done the calculation. Now it's time to do the journal entry. So I've just picked a sample date, maybe December 31st, 2015. Typically you do these every month. They'd be adjusting entries, and you do them just like you would any adjusting entry every time you produce a financial statement. Obviously the year-end entry would be a pretty important entry to get right. So I'm just assuming this is a year-end entry. So it's dated December 31st. There's a debit to income tax expense for $2,500. And I showed you in the last page how we computed that. And then the credit that's offset against that is a liability because we haven't paid the tax bill yet. How do I know we haven't paid it? It wasn't even due yet. That's why it's deferred tax liability. So notice, and I'm just pointing this out because sometimes we get so caught up in things in intermediate accounting that we forget the simple principles of accounting concepts we learned. One of which is all account types are some type of account. So income tax expense is an expense account. Income tax payable is a liability account. There's your deferred tax liability. They're recorded net of tax. That's a big key to getting accounting for income taxes right, is the taxable income is not what we're recording. I've seen jokes sometimes that our taxes are getting so bad in the United States that it's like take your taxable income and send it in, but we're nowhere close to that now. So taxable income's not the thing. Rather, we're going to compute the tax rate times that, and that's going to be the tax, and that's the liability. Just a couple of final thoughts here. First, there's no deferred tax assets based on these facts. So don't always assume there's not going to be deferred tax assets. There just wasn't any here. There were no tax reductions later. If there was remember, in both cases we had here, there were going to be tax increases later, or something that's not taxed yet that would be taxed later. Here, there's nothing that's not taxed, nothing that was taxed now that won't be taxed later, but that could happen. It also can happen that you could have a deferred tax asset and a deferred tax liability in the same year. I've done some work for big companies in the past, and when you do, they almost always have both. So you don't net those. You don't have a net deferred tax asset or a net deferred tax liability. If you have both, you show both. Finally, the permanent differences are not part of the deferred tax liability in this example, and they would not be part of a deferred tax asset. If we're never going to have to pay tax on the insurance proceeds, and we're never going to get a deduction for the other half of the meals, these are not temporary differences. They're not part of a deferred tax liability or a deferred tax asset. Well, as always, if you have any questions, please ask. You can do it through the discussion board. You can do it by sending me an email, or you can call or text me. Good luck. Let me know if you have questions.